A very good morning to everyone present here. I welcome you all to the second day of the 19th Inclusive Finance India Summit. Thank you for coming. May I please request the gathering to settle down? We are now ready to begin the session. Please put your mobile phones on silent. I'd like to thank each one of you for joining us this morning for this technical session titled Financial Inclusion Leading to Financial Wellbeing, Expectation Setting and Measurement. It is my pleasure to invite on stage the esteemed panel for this session. This session will be moderated by Ms. Misha Sharma, Lead Household Finance Practice, Dwara Research. Ma'am, you could come on stage. The panelists include Dr. Susan Thomas, Senior Research Fellow and co-founder of XKDR Forum, Mr. Abhishek Agarwal, Managing Partner Axion, Ms. Seema Prem, CEO of FIA Global, Mr. Jaspreet Singh, Global Lead, Financial Health and Innovations, UNCDF, and Mr. Krishnadas Nair, Head Product Solutions and WP Retail, Axis Bank. If they could all come on stage, we can begin. So I look forward, we all look forward actually, for a thought-provoking and insightful discussion. We have an hour and 15 minutes in this session. And saying that, I'd like to hand over the session to Ms. Misha Sharma. There will be a presentation preceding this panel discussion, which Ms. Thomas would be doing. Thank you.
Hello, am I audible? So Divya, it's already 9:50. So how much time do we have? When should we wrap up? Sorry. Okay. Okay. So that's about 11:05, 11:10. Okay, okay. So hello everyone, thank you so much for joining us for this session today morning. What I'll do is I'll just give a brief opening remarks about what the panel discussion is going to be about and what this session is about. And we'll then start by a stage-setting presentation by Susan Thomas, Dr. Susan Thomas, and then we'll open up the discussion among other panelists. Right, so like I think Divya has already introduced all of us, so I'll not get into those specifics. The panel discussion is really titled Financial Inclusion Leading to Financial Wellbeing, Expectation Setting and Measurement. What we'd like to do in this panel discussion is really to discuss the role of inclusive finance in improving the financial well-being of households and whether the expectation from financial inclusion in bringing about a transformative impact in the lives of households is realistic. So we will be discussing this session in two parts. The first part will focus about whether the expectation of inclusive finance in terms of, financial well-being, in terms of a positive impact on the lives and livelihoods of low-income households is realistic. And the second part of the discussion will be centered around what is financial well-being really, because different institutions, multilateral agencies, bodies have different kinds of definitions they've articulated in different forms. So how can we arrive at a common consensus when it comes to defining financial well-being? How can financial well-being be measured? Because measurement is important, because once we think about the definition and the components, then we will be better placed to think about how can financial well-being be measured, and more importantly, how can we operationalize this measurement framework, because it's one thing to come up with a measurement system and just have it published, but it's another thing to actually speak with different financial inclusion providers, financial service providers, foundations and NGOs working in this space, take this measurement framework to them and ask them to kind of use it, collect the data on it, and track the financial well-being of their customers over time. So that will be a very interesting discussion about how we can operationalize this measurement framework among the sector stakeholders. So that's the two part of the discussion. Now, in terms of opening remarks, I just want to make two quick points. One is that first, at the outset, I think we should define financial well-being. And so, what the definition that we at Dwara Research resonate with is that financial well-being is broadly defined as the extent to which a person or family can smoothly manage their current financial obligations and have confidence in their financial future. So that is the definition we resonate with, and it's put together by UNSGSA. But different institutions like the Center for Financial Health at UNCDF also have a very similar definition. So now we'd like to discuss in the first part of whether this expectation from formal finance in really improving the financial well-being of low-income households is realistic, or are we setting too much of an expectation and burden on formal financial services and the role that formal financial service providers can play? Now, we think this is an important question to dwell on because the premise of financial inclusion as being beneficial to customers of finance still waits to be widely established. Now, it is a controversial statement, but it is true to a great extent that there are not many rigorous, holistic, nationally representative surveys, data sets, and studies that can really tell us very confidently that yes, formal finance has indeed increased the income, reduced poverty, increased consumption, increased asset ownership. So this question is still important to be dwelled on even after 20 years of us working in this space. Evidence, like I said, on the consequence of financial participation is sparse and limited to small sample studies in various contexts, right? So that is the first part. The second part of the discussion will be centered around how financial well-being can be measured, what are the components of financial well-being, and is there merit in FSPs operationalizing this measurement framework? And what will be the usefulness for FSPs in doing so? Now, we've also kind of articulated in the chapter that Susan and Indradeep have written for the IFI report this year that measurement helps to validate or invalidate the premise that drives the policy. But more importantly, it also functions as a feedback mechanism using which the implementation of the initiative can be tweaked, right? So therefore, it's very important to get the measurement right. For a long time, the impact of formal finance was measured in terms of increase in income, consumption, and the very popular improvement in women's economic empowerment, right? But there is some sort of a growing consensus emerging that there is a need for an alternative way or approach to think about and measure financial inclusion, right? So what we will be doing now is that Susan will be making a presentation. She will be talking about the financial well-being and financial inclusion measurement framework that XKDR and Dwara Research have put together. She will talk about what the logic and thinking behind that measurement framework is. And then we will kind of get everybody's reaction in the audience as well as from the panel on what is the usefulness of that measurement framework. Does that make sense? And is there a need to sort of tweak it? So with that brief remarks, I'll hand it over to Susan. I'll invite Susan to give us the stage setting presentation. So Susan, 10 minutes you'll have.
I'd like to thank the organizers for having invited me to speak today. I know that originally it was Indradeep, but he's unwell, and so he was not able to make it. And so I will present the bare bones of what it is that Indradeep and I co-authored as a chapter in this year's IFI Summit IFI report. And this is a proposed financial inclusion measurement framework. I say India here, but we are all very cognizant that this is a live problem all across the world. It's not solved. And when we look at it, we see that this is a common problem. It can technically apply all across the world. So let me start. I know that we talked about it all day yesterday, and it's going to be something that we worry about all the time. But I would like to just take one 30-second pitch off to say why should we worry about financial inclusion measurement. And I think the pitch of this slide is that when you have poor measurement, then you will have a paralysis, right? And we were just talking off the line that there are supposed to be these patient social impact investors that look to making investments in financial sector firms that address the problem of improving financial access and participation by low-income households. And while my panelists do not seem to agree, I think that perhaps one of the reasons that we are not seeing that kind of social impact investors in India is because we are not able to present them some metric which can be trusted and reliable, by which they say, okay, it is actually happening, right? And this has been a problem for social impact all across the world. How do we know that when funds are being put into a social program or a socially beneficial program, that it's actually having the impact that it goes through? So we see that there's a big difference between how social capital goes into Indian renewable energy, but not similar kinds of focus is not coming up in Indian financial sector. And one of the pathways that at Dwara Research and XKDR Forum, we think we may want to solve this problem is to see how we can improve financial inclusion measurement. Now, what is the strategy in measurement? And there are many measures out there because this is not a new question or it's not a new objective, right? People have been thinking about financial inclusion for the longest time. And the number of measures that we can see, we once again discussed it yesterday, all of them are typically from the suppliers or the service providers end. They are aggregate, and for many reasons, this is unsatisfactory. What we really need to know is the impact that when there is finance that is opened up into the life of an individual or a household, as Misha just said, does it have a benefit that is visible? If not today, but perhaps in the medium term and in the longer term. So what we need to know is what is really going on in the life of the household that chooses to participate in the formal financial system, and whatever are the measures that we're putting together to track the financial inclusion for the household or the individual, are they generating meaningful, are they showing that this participation is generating meaningful impact? So for example, we all get very excited by seeing that so many UPI transactions a day is happening. But really, if 300 times more cash transactions are happening, what's the big deal, right? So we need to know what is the impact of those UPI transactions. We need to know more about how they are being taken on board, whether it's persistent, and at the end of the day, are people really benefiting from using these transactions as compared with just handing out cash? So we need to think more about what finance is, what financial inclusion seeks to achieve. And so I'm going to spend just about 2 or 3 minutes to talk about what the purpose of finance is and a framework that we think all policy initiatives must consider before they put the intervention in place. So number one, what's the purpose of finance? At the first principle level, finance is supposed to allow people, whether it's an individual or a household, and typically it's a household because these decisions are made together. You don't make these decisions about financial participation in isolation. You're supposed to be able to manage consumption better. So most of the times people think, oh, we need, the old theorists tell us that we need to smooth consumption. And therefore, I need to make sure that I'm consuming exactly the same amount every month, every year, 100 years. But we know this doesn't happen. We need to be able to say that whatever consumption requirement is being made, without breaking into a sweat, I should be able to make it as a household. The second is, as Misha pointed out, how can finance help sustain gains to income, right? Or build up the wealth of a household or build up savings of a household. Whatever measurement system that we think about for financial inclusion, we should be able to use them to help answer these questions. Is this the way that the household or the individual is being benefited? So traditionally, this is the second problem I think that we should worry about a lot more when we think about financial inclusion, is that typically when we think about financial inclusion, we think about debt. It's all about credit. Every single story we heard yesterday was about credit, but that's not true. I mean, and I think that my panel is a lot more nuanced on it. This Seema's firm talks about a lot more about finance as compared with just debt. But we should think more about other kinds of instruments which are in finance. Increasingly, people think about insurance, but there are other kinds of things as well. And the question is, if we just restrict ourselves to formal financial system, products and services, how is it that those can help the household a lot better? So we think that it is useful to think about measurement from a framework that we have seen deployed in policy initiatives in other areas, right? Which we call the inputs, outputs, outcomes framework for measurement. This is the standard idea. And the canonical example that will obviously come to your mind is education. So all of us will remember 10 or 15 years ago, there was an ASER report that said, okay, so we as the government of India, or the people of India, are building a lot of public sector schools. Children are getting educated, apparently they're passing exams. But when they went out and asked how many of those children can actually read very simple text or do very simple mathematics, what is the fraction that comes out as being numerate and literate? And the answer was very little. And that was a feedback loop to the people who are doing education policy, saying it's not about building a kacha structure or a pakka structure. It's not about hiring teachers. It's not about getting the kid to pass an exam. It's about building literate and numerate children and people. Similarly for health, health policy is you go out and build a hospital, hire doctors. But what we really need to do is to get healthy people, because healthy people are a critical input for economic growth. If you do not have healthy people, if your staff are sick half the time, you're not going to have the kind of growth that you should be seeing. So this has been extremely influential in various other places. And our question was, what can we do by way of applying a similar framework into measuring financial inclusion? And so we thought, what are the inputs, what are the outputs, and what are the outcomes? The inputs we can think of as the presence of the financial service provider, which is allowing access of these formal financial products to everybody. What are the outputs in this case? That once there is a bank account that's opened, or once there is an insurance product that has been sold, an insurance account that has been opened, we need to see a continuing usage of that, right? And that's been talked about for banks, but there is insurance. Insurance is one of the largest, most widely spread product, formal financial sector product in India. Do we ask how many people go back and pay the premium once again? I mean, we know about scams like ULIP because you were tied in to do such things, but out of their heart, because they thought it was a useful product, do people go back and renew their renew their insurance premiums? So there is inputs, which is, do I participate? That is, do I take access? There is the second part, which is outputs, which is, do I continue using it? But the last one is what I think Misha also emphasized in her opening remarks, which is outcomes, right? Once I get included or participate and start using finance, am I better off compared to a similar person like me in terms of how I'm able to make my consumption choices more easily and how I'm able to grow my wealth and stature? Now, we ask the questions, how do we measure inputs? The standard thing would be to go out, take a random sample of households and ask, what kind of financial products do you hold? Right? And we have a limited number of those products. In one of the big surveys that happens every year in India, there are about 15 products that every household is asked in terms of what they hold. The measurement about the producer side, as I said, all of us see it. The RBI will tell you how many accounts are opened, how many UPI transactions are happening, but really counting these things is not the useful measure. Think about an analogy from how well justice is served in the country, right? When you think about crime measurement or whether we are doing well in terms of managing justice related to crime, you don't go out and count the FIRs. What we would like to do is to go to the household and say, how safe do you feel walking in the streets every day? How do you measure outputs? Once they've participated, so this is in a certain sense linked, right? If the household does not have the product, then you can't ask anything about their usage. But once they are actually participating, you can ask what are they doing with their financial accounts. For example, payments. We'd like to think that one of the ways to do it is to go up to every one of you, all of you are participants in the financial system, and ask, out of the last 5 transactions that you did, how many of them were based on cash? And if it is the case that a large fraction of your transactions, your last 5 transactions that you can remember is cash, then you're clearly not using the financial system too well. And finally, how do you measure outcomes? I think the panel will spend a very long amount of time talking about this stuff, but we try to say, in addition to what Misha and the rest of the summit session was about yesterday, which is thinking about well-being of the household, which is how well do I perceive that I can manage my life going forward? How comfortable and confident am I that when there is an accident or a problem that happens, I'll be able to manage it financially? We also think it's important to measure the ability to manage consumption. So who are the people in the country where the consumption management is very poor? By which I mean, if there is a shock, someone falls ill in the family, then the kid doesn't go to school because the school fees can't be paid. Right? These are the people who actually need finance the most. And linking it back to where we start, like who are the people who care about financial inclusion the most? There are the policymakers, and hopefully one day the financial service providers, because they want healthy population of customers. But when the policymaker thinks about why financial inclusion should be done, when a policy intervention is created so as to introduce something into the life of a household, did their ability to sustain their consumption go up or go down? So we have several schemes that have started in the last couple of years where we need to, I know, I think that I'm at 11, so I'm going to take some more time. Uh, and so the question is, does more finance in the life of a household induce sustained gains in income or savings, actually? Because income can be orthogonal, but savings and wealth is what we need to focus on for the life of the household. So what we did at the Dwara Research Foundation and XKDR Forum is put together some of these thoughts into the financial inclusion measurement framework, where I'd like you to walk away with at least an understanding of what we think are the key features of the framework, which is number one, this has to be done through a survey instrument, because this kind of information about households and their well-being or their consumption is often private to that household or the individual, and we need to figure out how we can get a sense of that. So build a financial inclusion survey instrument, focus on the household. Rather than think about a single financial inclusion index, perhaps think about an index for inputs, outputs, and outcomes, because the interaction of these three will help us understand better how financial inclusion works for the household or not. Create a minimalist survey, because we do think that at the end of the day, the people who are best able to observe their household in its entirety is probably going to be their financial service provider. Regulators, policymakers sit at a much higher level, whereas the people who deal with the customers and their pain and their questions are the financial service providers. But they have to incur cost to collect this information, so it has to be a minimalist survey. And finally, it is important that we observe how households grow once they are participating in the financial survey. The last tricky thing that I'll place on the forum is that it is important, we believe, to take a survey of both the low-income households, which is often the objective of financial inclusion policy, but also look at the high-income household, because if we are doing things right, then the gap between the high and the low-income households using finance should be coming closer. So there are some things that you will read in the report, and perhaps I should not spend too much time on it, but I wanted to say that when we thought about the survey questionnaire in terms of what should be inputs, outputs, and outcomes, we thought that we could break up the inputs into broad sectors as compared with every single kind of financial product out there. So transactional, which is like your bank account, risk-free assets, which is like your fixed deposit, old age income support, like a pension, life and health insurance, general insurance, and risky assets like stocks and mutual funds. And outcomes, this is very well understood, and they'll spend a lot of time doing it, but the standard 5 things that you track about a household is what we wanted to put into the survey on outcomes. I want to present very briefly some learnings from a pilot survey. This is something that XKDR and Dwara Research Foundation did in collaboration with a financial service provider in 2021. The lockdown was on, and so it was administered over the phone. But what is interesting is that we got a 60% response rate when we surveyed 310 households. Sorry again. No. Okay, 60%, oh, thank you so much. So a 60% response rate when we surveyed 310 households over 2 geographies. And what the survey had was 78 questions. And the 78 questions were broken up across these 6. Ideally, if there's an FSP which has a long-term relationship with some of their households or their customers, some of these need not be repeated, right? Because you're already covering it when you reach out to these with with your products. But these are some of the aspects about the households in the pilot, which is that their monthly income on average was about 17,000 rupees. Monthly expenditure was about 15,000 rupees. There was between 4 to 5 people in the family. They had technical exposure, which is, did you have access to the internet or to network? And the number 0.42 captures the amount of physical assets that the household has. What you will see in the financial inclusion score, which is the average financial inclusion score across the households, is that the input is 22%. So if you had 10 instruments, then the families on average were holding 2 or less than 2. The output score is how much they were used, and that was a little less than the input score. And finally, the outcome score seems to be much larger than either, right? So something is going on. How do these scores correlate with each other? So the first one should not be a bit of a shock, right? Because if you have input, that is, you've got the products, you're likely to be using it. So that's a very high score. But the outcome score when you have input is higher as compared with the outcome score with respect to output, which suggests that there are some products that you don't have to keep touching, but that's how it works. There is some interesting features that show up when you look at the household factors. What we found is that digital infrastructure matters a great deal. So if you have access to the internet, is that right? Is that what you are capturing through digital infrastructure? Digital infrastructure usage is how many times are you doing your transactions using a digital payment system, right? So those are the big things when we look at the well-being. So learnings from the pilot is that the scores are useful. They are correlated with the household well-being. Of course, richer families will score better on outcome, that is well-being, as compared with a poorer household. But when you have finance, it does add. What is missing is that we do not have, it was a one-time survey, so you're not able to track these households through time. Takeaways: to strengthen the credibility of financial inclusion, let's measure better. And I think that the work that we did demonstrates one possible choice. The survey instruments and the scoring methodology is available in the public domain, and it's very easy to apply, we think. I know it's 78 questions, but it's supposed to be much less than what we had come up with. The FSP deployment is what we think is more tangible and real time in terms of creating such information. Lastly, it is scalable to other countries. These problems are not specific to India. India happens to be a natural lab where we started it, but these questions are something that can go across the world. Thank you very much. Sorry for having.
Thank you, Susan. So without further ado, I'd like to open the floor to all my panelists sitting here. So first, I hope you got a good sense of what the Dwara XKDR framework is about, and would love your reactions on that maybe later in the discussion. First, I'd just like to start by asking one question which all the panelists can sort of respond to, which is, can financial inclusion lead to financial well-being? And the reason I'm asking this is that globally we are seeing that while the levels of financial inclusion have increased in the last decade or so, financial well-being has not necessarily improved. So in the Indian context, I'd like to give a couple of statistics. Household incomes have been affected due to the COVID-19 pandemic, and there's a large increase in informal employment, which has implications on how households save, spend, and borrow. There is a decrease in the uptake or renewal of financial assets such as fixed deposit accounts, health and insurance, and pensions account. There is nutritional health and educational deficit occurring due to stressed household finances. According to the World Bank's Findex report, 9 in 10 Indian adults are worried about facing severe financial hardship as a result of disruption caused by the pandemic. But these are statistics during the pandemic, but even before the pandemic, according to India's NSSO, All India Debt and Investment Survey, which is a nationally representative household survey, the survey highlights alarming levels of debt to asset ratio, particularly for low-income households. The debt to asset ratio for rural low-income households is 40%, and the debt to asset ratio for urban low-income households is 550%. right? So my question is, can financial inclusion lead to well-being, or are we burdening the goal of financial inclusion with more than what its potential is? We'll start by you, Jaspreet, and we can go in line.
Sure. Thanks for the report. I think it was nicely done. To your question, Misha, UNCTF's take is few on this. One, financial health or financial well-being, as we are calling it, is not an ex panacea, right? Or it's nothing, that we are saying that financial inclusion is an old subject and we are moving to something very new altogether. Not at all. It's just a additional way of defining, creating, and measuring impact of financial inclusion. The goal of financial inclusion, when it was defined some 10 years back during the South Korean presidency of G20, right, it was done with the objective that the world at that time was far behind in terms of how formal system was serving a large majority of the population across the world. And the need of the hour of that time was to focus on the product and the infrastructure to be able to get people in the system first. But now, as we have got people in the system, the question is, how is the system serving them to better their lives from where they are now? The statistics that you pointed out obviously have are well beyond of the domain of a financial service provider, okay, in terms of how people interact in the day-to-day life, because it's not only about the financial products but a lot of other factors which plays into it, be it inflation, be it availability of resources, and so on and so forth. But the question is, uh, to a greater extent, the formal financial system, through these services, in a better way, can, if not address all the challenges, fill in for some of those gaps which exist, at a household or individual level. And that's a journey towards, improving financial health and well-being. It need to be noted that it's not only a responsibility of the FSP to do all of this, because then we're also talking of things like social protection mechanisms in the country, which also have to kind of play their own role in terms of how people are able to manage these shocks or be able to secure around their finances, right? So all of that cumulatively plays a role, but the absence of formal system itself would have not allowed other things to happen, which is now already there. The question is, now, are the products that we are delivering or providing to the end consumer uh, addressing the right needs for those consumers or not, especially the LMI segment? Because most of the time, we do not create services separately for LMI segment. It is created for people at large, but their needs are very, very distinct in terms of how they interact on a day-to-day basis with their finances, and with smaller income set and other constraints around them. So it's important to think of, are the products really serving the LMI segment with the right approach or not?
Yeah, thanks, Jaspreet. Krishnadas, you'd like to take them?
Sure. Thanks, Susan, for that report. Quite insightful. And from our perspective, from a banking side of it, we've been working on financial literacy programs, financial inclusion for many, many years. And the way I see is that financial well-being is a journey, and financial inclusion is the first step towards it. Unless we don't take that first step, I think it's difficult to even get into the next level of measurements, right? So has financial inclusion had its impact? My answer would be yes. How much have you measured it? I would say that it's is the way the product and services have been consumed by these households, right? That's one of the best way to measure the outcome, right? If today I'm giving him a loan of, let's say 5 years back I gave him a loan of 25,000, today's ability to take 1 lakh loan is there, which means that it's a proxy for me to say that the outcomes are there for us to feel that it's working, right? So from financial inclusion perspective, it's a very important step, and unless we don't further create a more systematic way of tracking the outcomes, we'll not be able to improve the inputs, right? So from financial well-being perspective, it's a journey, and there is no a state where we can say that the household has reached the ultimate state of saying that he's financially well-being. So we have milestones, and we track against the milestones where the customer is able to reach that milestone or no, right? So when we do our financial inclusion for especially the low income household segments, we look at the bottommost segment where even access to credit, forget about savings, forget about insurances, very simple things like even for their economic activities. It's like I was listening to, uh, one of the speakers in yesterday's session where she made the statement, "Aaj kamaya, aaj khaya." Right? That's how their life is, right? So if you're able to bring credit to them to start with, and then graduate them to the other aspects, which is whether we call it from savings, simple savings products, to health insurance, because that's again something which is very important, and we've been driving it through various government schemes. So it's important that we create the awareness, and financial inclusion is the only way to create that awareness that draws them. The fact that they can have access to credit draws them to be part of that financial inclusion camps, and from there on the journey begins. So financial well-being it's a milestone driven thing, and financial inclusion is critical for us to achieve that milestones. And it'll be different as I move from within the lig. If I move to a different segment, a evolved household, you will see the difference. Yes. How do we measure it? It's a question that we would like to really deliberate on. But the fact that financial inclusion has created impact and will continue to create the impact, I mean, that's what I would like to add.
Oh, fair point. Seema, your thoughts?
So when we started off in Yeah, so I run an impact fintech, and so when we started off in 2013, around 800 million people in India did not have a bank account or were unbanked. So I think the first step for us as a social enterprise, we looked at upliftment from poverty as a goal, was to just provide bank accounts. So basic right of any individual, I believe, is a bank account, and we started off on that. So people would come, deposit money, immediately withdraw the money once a bank account was opened because they were scared. They were handling the bank account for the first time. Over a period of time, we saw transactions growing and then savings getting built, confidence in savings and fixed deposits, recurring deposits, and over a period of time, financial well-being, financial assets getting built, financial well-being getting built. So Bankura is a Maoist infiltrated area in West Bengal, and there I had a customer called Tanuara. In 2013, she was about 22 years old, married. She had two kids. And 3 years later, when I met her, she was unbanked. We had provided a bank account. And the question that she asked me is, yes, now I'm comfortable. I have a bank account. I am saving money. I have recurring deposit, but I would like more. So what was she looking at? She wanted credit. She had a tailoring sewing machine, and she wanted to set up a tailoring unit and employ two girls. She wanted to increase her income. She wanted higher return products. So beyond fixed deposits and recurring deposits, are there other products that I can avail, which will give me higher interest rates so that I can grow my wealth? So then we realized that um, she also, so one thing which she told me, which really shook me at that time, was that because I'm saving money in my bank account, it has made a difference to my nutritional well-being because I'm able to stretch the money across the month. And so I'm able to eat at the end of the month, and there is no skipping of meals at the end of the month. And we know that towards the end of the month, typically it's the women in the household. If you have shortage of money, that ends up skipping meals. So here was this really good example of how just a bank account makes a difference on the nutritional health of women. And so yes, that does comes from financial well-being. So I do believe that financial inclusion is a significant contributor towards financial well-being. But when we looked at Tanuara's journey, what we realized was that yes, I have started off basic accounts, provided basic transactions. Now I need to graduate. She needs loans, so which is income generating, increase her income. She wants wealth protection. I want to save for emergencies. I have frequent floods in my villages, so how do I protect against that? How do I protect against health emergencies? And I would like higher return products, which means I want to grow my wealth. And that's when we realized that financial well-being, financial inclusion, right now in India, we talk about is only access, adoption, and then usage of financial transactions. UPF transactions have quadrupled, doubled. These are the statistics that we hear about, but we need to actually graduate into the financial well-being aspect, which is increase your income, generate more wealth through higher return financial products, and provide for emergencies, especially in the light of the pandemic, health emergencies, and even natural floods, calamities, natural calamities which are causing financial shocks to individuals. So now if we address that, then yes, you're taken care of financial security through basic transactions, move over to financial resilience through health insurance, livestock insurance, property insurance, and then financial freedom through higher return financial products and even credit. So it is a journey, like Krishna was saying, and financial inclusion as a significant contributor to financial well-being. And it is not that people who do not have a bank account or are not financially included are not financially well off. Yeah. Thank you.
No, thank you very much, and thank you for having me here. I think the story which you narrated for the customer, I think it's not very different, and I think rest of us on this panel will agree, because this is something which we keep on hearing from our customers as we go to the field. But coming to the financial inclusion to financial well-being, and I think I have witnessed it myself, and which has brought me to this sector. Just quickly, that is story. When I was in Afghanistan working for a World Bank project, I met a microfinance customer who was living on a $2 a day, and or actually 50-70 cents a day back in that time, and he was given a $70 loan which changed his life. And from it 50-70 cents a day, this family of five became a man of $1,200 net worth over 10 months period itself. And seeing that impact on the life of the customer, I felt what I'm doing at this side, let me see how this financial inclusion or microfinance or development side can help me. So that brought me to this sector. But that's 20 years ago, and today here I am in front of you. Now let me ask a question to this audience, given we are talking about from financial inclusion to financial well-being. How many of you think that you have done appropriate savings for your retirement? Do a quick hands up. How many of you think how you have done appropriate savings for your retirement? I can see few 5 or 6 hands. Thank you very much. That itself tells how financial well-being we are sitting in this room. We are all educated, working in financial inclusion. And that's lies the problem. And what I'm trying to go there is, I think financial well-being or financial inclusion has a little bit become a misnomer here. We say that we are looking at this at the LIG, at the bottom of the pyramid, but we are not looking at the financial well-being very holistically. We tend to ignore ourselves as well in this. We are not doing enough on it. And let me say, I think, Misha, you talked about the point in terms of looking at the access to debt has changed, and how the poverty or how the exposure has been very high into the urban areas versus the rural areas. Part of it is related to the access to the products. Now, the customer segment in which we are looking at the financial inclusion stroke financial well-being is, if these easy products are going to be available to them, then money is attractive. Everybody wants to have the access to money. They end up taking it. So who is responsible into it? Part of it is the FSPs. Now, as a FSP, I need to ensure when I'm giving that product and that service, and here I'm not differentiating while I'm a big lobbyist towards the credit product, because credit is a product through which you can make the consumption smoothening, and you can have an easy outreach, and can also make it economical to deliver the product out there. But when we are delivering that product out there, what is very, very important, that have we understood the customer dynamics, customer need there very well. If that women or if that family, and family becomes very important, because in financial well-being, it's very important that you understand the household. It's not about just the customer to whom you are offering the product. And particularly in our segment, when we are approaching this through the lens of the women customer, and it's the women who is going to look at the entire household, it becomes our responsibility as a responsible lender, as a responsible FSP, that we understand what is really the requirement of the customer, rather than pushing the product out there. Insurance, why insurance has not been successful into the Indian market is, one, there's a failure in the product design, and second, it continues to remain as a push product. We are being sold or being taught that you have to sell these X number of policies. Why can't we change the approach there a little bit? Let me educate the customer why the insurance is important for them. And we at Axion, we have witnessed it ourselves in a pilot which we were running in the state of Odisha, which is one of the poorest state. When we were running this pilot project on 50,000 women, only 10% of the women had subscribed to the PMJDY sponsored insurance products, which is available at 12 rupees and at 300 rupees. I don't expect every woman which is earning 5,000 rupees a month to subscribe to a 300 rupees insurance product. I do not expect that, because for them, what is important is having the meal both the times in the family. But when we educated, and I'm using the word very consciously, the idea was not to sell anything, it was to empower them with the knowledge. And education is the wrong word, I used it, so apologies on that. When we empowered them with the knowledge that these are the products available to you, and this is what these products can do for you, there was a sea change. We saw 13% numbers going up to 84% number from an insurance subscription. These are the women who went on their own to the banks from where they had the account and subscribed to the products. So I think I could not have agreed more from the perspective, Ivisha, you asked me the question that how the financial inclusion leads to the financial well-being. That is why I am here into this sector, and I have seen it happening myself. But just to sum it up, I think the responsibility lies in us, that how we are approaching the household, how we are approaching the customer in looking at what's the solution we are offering to them.
Yeah. So thank you, everyone. I think overall I'm hearing a very positive narrative. So that's really promising. I'd like to, a couple of thoughts, and I'd like to get Jaspreet your reaction to this, right? So Seema mentioned that financial inclusion is a significant contributor for financial well-being, right? At the same time, in India, what we're seeing is beyond bank accounts, the access problem itself has not been solved, whether it's insurance, health or life, or pensions, right? So a couple of thoughts that are running in my mind is this conversation relevant in this context, in the context of this conference, etc.? Because like you said, financial well-being is not a panacea, it's not a new goalpost. Yet, if I may be very candid, there is this obsession, in the sector, me included, of changing the narratives and changing terminologies. It started with microcredit, went to microfinance, went to financial inclusion, and now it's all about financial well-being and health. In fact, the title of this year's conference, IFI conference, is Financial Resilience and Financial Health. So are we as a sector, me included, obsessed with terminologies when in India financial inclusion itself has not been solved, right? Are we thinking about it in the wrong way? And second question to you, Jaspreet, is about the financial empowerment angle, which Abhishek mentioned. And in fact, even yesterday, the chief economic advisor, Dr. Anant, mentioned that for financial inclusion service providers, it's important to go over and beyond financial services and really financially empower their customers. But are we burdening the financial sector too much with saying, okay, ab de diya, like credit de diya, ab usko educate bhi karo? Is that too unrealistic, right? So the reason I'm asking that question is, as all of you rightly said, financial inclusion is just one piece of the puzzle in financial well-being, right? And financial well-being will come with the right kind of education, occupation, social protection, and there are 10 other things: health, sanitation, 10 other things, right? So how can we work with other players in the ecosystem beyond the financial sector to make all of this happen? So I've asked you 2-3 questions. If you can condense and share your thoughts.
Okay, I'll start with the defining aspect of the terminology over here being used, right? Financial well-being is a terminology that we have been throwing around for some time now. There was a reason, why even at UNCDF or UNSGSA we didn't adopted financial well-being, okay? And we stuck to the financial health, the terminology. Okay, I'll give a case in point. Think of me as going to a doctor, and I tell the doctor that oh, I have having pain in my stomach today, right? The doctor asked me to take some vitals, get a blood test done and everything else, right? And then basically prescribe me a medicine. It should work in a similar fashion, right? Because the idea should be that the service provider or the FSPs over here, are those doctors who, based on certain vitals, should be making a decision in terms of what medicine to serve to the customer who has come, rather than based on the fact that I am telling, oh, I am having pain in my chest or somewhere, right? Which is a very well-being concept, which takes you into a little more of an emotional dimension of how I feel about few things, right? Rather, kind of looking at the exact numbers in terms of what my vitals are telling me about. And hence, on purpose, we stuck to financial health as a terminology to define, what are we really trying to get and achieve over here. The second thing we defined was in this entire approach was, and everyone, at least the participant of the working group on financial health, agreed that uh, financial, the concept of financial health is like a bucket, okay, where you have three or four aspects into it: resilience, security, control, and freedom. Or we can, you know, keep on calling it different in different ways: day-to-day expenses management, feeling better in life, and all in all different ways. The application of the all the concepts will not apply to an individual at the same time. It will be one or the combination of the other which will be applicable or will be relevant. So that means we are also, trying to create too much of a theoretical concept over here, and overburdening ourselves in terms of how we want to approach this entire subject. Okay, this has to be made a little more practical in terms of how can industry adopt it and serve with better services the end consumer. We have seen with examples with what CBA has done in Australia, or what Discovery Bank is testing in South Africa, in terms of the approaches that they have taken to basically use the aspect of measuring to create better service or products for the consumers. Understand what are the consumer needs at a certain point of time, because there's a time dimension as well, which comes into play here, because the customers' need and requirement also keep on changing based on the environment they are interacting in. So the I think we need to kind of distinctively put out that we are not doing a theoretical exercise here of calling it a financial health or well-being concept, but how can industry actually be the owner of this entire thing when financial inclusion and why access and usage became such easily acceptable indicators was because it was easy to measure it to begin, right? I, as an industry or a bank, I don't have a cost to put in to basically measure it, because I know it from a top line number. But now when we keep on talking of the other indicators, the thing is that we need to shift the conversation from top line to bottom line. Okay, that when you basically do this, then is it kind of contributing to your bottom line? And the moment you basically build that narrative, the industry will be a better participant in terms of how they start looking at this concept and why they should be participating in it. To the point of the empowerment, financial empowerment, and is that role of a bank or financial institution? There's no point of taking side in terms of is it good or bad, because we are all equal participant in helping the consumer make the right choices. Okay, the question is the bank or the financial institution making enough effort to provide that choice in the right way, or is it just a marketing of a product or a service? Okay, so how you are basically placing your offering is where this question of empowerment really comes into play. But it's a collective effort where everyone has to kind of continue building onto it, because it's not a job of one institution, be it a government or civil society. It's everyone's collective effort which will kind of either make or break it.
Yeah, thank you, Jaspreet. I think that's a great segue to the second part of the discussion, which is about the measurement framework and how we can operationalize it. Before that, I just wanted to ask you, Krishnadas, right, like about Axis Bank's unique approach to serving the low-income customers, and how do you see financial well-being playing out among your customers? We also saw that Axis Bank got an award yesterday, so certainly there's something like you guys are an outlier and doing something outstanding. So could you elaborate a little bit on that?
Sure, Misha, and thanks for that acknowledgement on the award. It was, if I have to get a little bit more in details, let me explain with the model. So the way currently we function, we have three models, which is driven by Axis Bank, and we also supported in through the Axis Bank Foundation, which does a job outside of what Axis Bank is doing. So if you look at Axis Bank today has three structures. The first is we drive the FLP program, which is called Sanchetna. And through Sanchetna, we try and reach out to customers who are largely underbanked or unbanked. And in that piece, we try and reach out and focus on three areas, right? One, we look at how do we inculcate the financial discipline of how to manage your income, whatever cash flow comes in, how to manage your day-to-day finances. Second most important thing that we focus on is about the health. Uh, COVID has taught everybody, and today customers also acknowledge that if I was informed, perhaps I could have managed it better. So we're getting these feedbacks during our sessions, and they're very keen to understand, what kind of insurance, what kind of, whether it's for asset, whether it is for their own earning members, right? There is a heightened need for them to understand the insurance aspect. So that is the second area that we look at. And third important part in our FLP program is about making them aware of the various government schemes, which if they subscribe to, they get a lot of benefits. They are subsidized programs. There are programs which today they don't know where to go for. So we look at this three-tier structure in FLP, which we call it Sanchindana, and that's how we deliver these programs. And we cover more than about 20 to 24 lakh customers annually. We try and cover them only through Axis Bank effort. So that has helped us to understand that segment, and we also looked at not just from a credit standpoint. We're also looking at from having a savings account, having a FDRD. There are customers who are saying, "Can I get a RD of 25 rupees, 50 rupees?" So that's the kind of denomination we're talking about, right? There are questions saying that my husband works in a different place, for him to remit the money, how it can happen. So remittance is catching up. So if you look at, products are going beyond just credit today. So while there are customers who don't have access to credit, but there are customers who are also asking about these kind of sophisticated product from a uh, low income households perspective. So it's evolving, and we're seeing the needs also changing as we see them. Like we did a small survey, and we've got about 40%, 35 to 40% of customers are more than 5 years. And when we studied them, we realized that their needs have evolved over a period of time. So it's an interesting program that we're running, and it is helping us to bring in new product and solutions.
Great. No, thanks. Seema, actually, you've touched upon that a little bit already about, how you see the links playing out through the story you spoke about. So, I mean, please feel free if you'd like to add more on that. But then I also wanted to ask you, how do you think about the measurement framework that we have put together today, Dwara and XKDR has put together today? We spoke about the input, output, and outcome approach, where input is about participation in all different kinds of accounts, not just bank account, but different products. Output is about usage, and outcome is about the impact, financial well-being, which is defined, just to recap for the audience, in terms of ability to manage day-to-day finances, coping and recovering from shocks, managing medium-term, long-term goals, and confidence in financial future, right? So what is your feedback on this framework that we've put together? Do you think this framework can be operationalized by FSPs? What is the usefulness of this? Is there a way we should streamline it to make it more practical?
So we have a very similar, measurement system in place. So we look at input. So we look at input from access, adoption, and usage. So from an access standpoint, we look at the number of partners that we are working with, banking partners and financial inclusion partners, so that it covers the entire gamut of financial services that a customer needs, starting with basic banking account to credit to investments. Investments include mutual funds, FDs, RDs, and digital gold, and also protection, wealth protection through insurance schemes, pension schemes, and protecting your families from emergencies. So that's how we take care of financial security, resilience, and ultimately financial freedom. So those measurements for us are put in place, and we have a so we look at number of banks that we work with. So if you go to a state like Jammu and Kashmir, it's very important that you work with not just the top public sector bank or the private bank there. You also need to work with the Grameen banks, because Grameen banks have deep outreach and branches into the interiors of Jammu and Kashmir, which the public sector and the private sector banks do not have. And if you work with them, would you get access to the customers and the unbanked customers around them. So the first input measure for us was the number of banking partners that we're working with. And we now work with almost close to 40 banks in the country. Then it came to looking at setting up banking outlets so that people get the basic right, which is a bank account. So we started off by ensuring that we are present in all states, all union territories, all districts, right to the lowest common denominator, which is a village or a ward in urban India. So all zip codes as well. So we're working in about 740 districts in the country, all states, all union territories. So that kind of took care of the access part. So 30,000 banking agents, and if you look at the entire movement, you have about 30 lakh all over. Once that is taken care of, then we looked at the measurement of output for us was number of bank accounts, number of transactions, gross value of transactions, and also number of social security schemes, credit enablement, etc., which leads to the outcome of, for us, the outcome that we measured, which is within our control, is financial increase in your savings, average savings per customer. So over a period of time, pre-pandemic, we have seen a gradual increase in savings by 30% year on year, and also increase in the percentage of financial assets, which is largely FDs and RDs. We also looked at a proxy, which was loans, to see an increase in the income of customers. So that's the measurement system that we have in place. So we carried out this massive dairy digitization project in West Bengal. What we did is we set up banking agents right in the dairy cooperatives. Started off by providing banking accounts, and then we said we would digitize their income flow. Because if we digitize an income flow, then it will lead to digital transactions and also creation of digital assets henceforth. And what we've seen at the end of that is it actually resulted in doubling of farmers' income, because now the bank branch manager is sure that yes, the money is coming into the bank account, a credit history, a financial history has been built, lending money to the customer. So from one cow, he goes to two cows, people with 5 to 10 farmers, and over a period of time, actually doubling of farmers' income and building financial assets. So yes, if you look at the measurement criteria, we need to get into a lot more details. And one point which Abhishek was mentioning about an empowered, individual, right? Empowered individual with the knowledge of finance, now knowledge of banking. So now their requirement is we want more. We want loans. We want mutual funds. We want to invest in stocks. Help tell us, and that's where we believe that the government should now focus on, because we talk about financial inclusion in India or even world over, but let's be very clear, it's just a bank account we have provided till date. We have not really looked at meaningful or holistic financial inclusion. And that means that if you're looking at credit, change the way you're giving loans to the credit invisible. You have two more regulators for mutual funds and for stocks and for insurance, getting them all together so that truly that will result in financial well-being.
Right. Thanks, Seema. So, Abhishek, if I can come to you now, right? Axion is obviously very uniquely positioned because you're working with different financial service providers who are catering to the low-income segment, right? So, a couple of questions to you, if you can share your summarized thoughts. How do you see the links between inclusion and well-being playing out between, the customers that the companies you invest in, playing out? Second question would be, how does Axion measure, the impact of all the work that's happening in this space, in terms of participation, usage of products, and the eventual outcome? It need not be in terms of financial well-being, but is there another way to look at it? I think we would benefit from hearing your thoughts on that. And and then also if you have any thoughts on what are the challenges you see in operationalizing a financial well-being framework at a large scale, because right now there is no common data set on this. Like Jaspreet rightly mentioned, we have data sets on number of bank accounts or number of insurance accounts, but nothing on financial well-being. So what are the challenges?
No, thank you very much, Misha. So just quickly on Axion, we work with a three-pillar approach. While we have Center for Financial Inclusion, which looks at the policy, advocacy, consumer protection, data privacy. The second pillar we have is really working with the portfolio as well as non-portfolio companies in helping the companies on new product design in a holistic way, customer engagement. And through that pillar, we also engage on the financial empowerment, financial capability buildings and others. And then the last pillar is the investment, which you talked about, Misha, from where we invest into the early stage startups to the growth stage companies to make the equity investments. And I'm not here to make the pitch about Axion, but just coming back to the items which you asked me about it, when we look at the companies in terms of how they are working from financial inclusion to the financial well-being, I think it's an overall approach which we look at it. What is the problem you are trying to solve, and how are you addressing the customer segment in which you are looking to solve the problem? We at Axion have been very uniquely positioned in that way. And when we came to India, even back in 2006, 2007, while the market was growing towards the group lending models, here we were seeing that how the approach can be taken to an individual lending, where you start assessing the customer at the individual level. And why we come with that approach? Because when you are looking at the customer at an individual level, then you are trying to establish their cash flows, their household requirements, their household cash flows, and what are their obligations and what they need to take care of in terms of the asset creation. A number of companies where we have invested or where we work with is like Dwara KGFS, which has a wealth management inclusive approach, looking at how the customer at the deep rural level needs to be assessed their wealth overall, and then being offered the products appropriately. We also work with Axis Bank very closely, and I'm very impressed with the Axis Bank approach, where they target their customer at the bottom of pyramid in terms of looking at that customer. How do you really empower them? And Krishna already talked about it, but I just wanted to call it out. And I think what is the key differentiator here is that you need to see this as a business case. And Seema just mentioned, as you are empowering the customer, by empowering the customer, which we do not realize, in fact, you have already created a demand. Seema just mentioned that now her customers are demanding or asking for mutual funds, equities, and other. And what has resulted is your upfront investment by doing an empowerment. And usually in the business cases, what happens is we are not very keen in doing that upfront business investment, because we match our P&Ls on a quarter to quarter or a year to year. If we can start to take a little bit holistic approach there, that okay, and that's what we do at Axion in our investment approach or analyzing the company. We look at that, it's not necessary for you to look at your P&L quarter to quarter or year to year. If you are making that investment into that customer, your P&L will start to show very significant trajectory as you have empowered that customer and in generating the demand from those customers. And I think a lot of it from an India perspective, if I really look at it, the game changers have been, while we have so many accounts which has been opened, and why it always have to be the regulator and government forcing these accounts. Now, given these accounts are open and so much as inclusion has happened, how can we create the traction on those accounts? And part of it, I think, Susan, you asked that today the UPI is happening, but is the cash transactions have increased, or is it as comparable towards the cash? I think I slightly disagree with that. I find it a significant mover today when I go to a coconut shop and I'm able to buy my coconut and making the UPI transaction. In fact, in a recent incident where I had to pay 3 rupees payment and I did not have 3 rupees with me, the shopkeeper was ready to take a Google Pay from or a UPI transaction from me. Now, what does this mean? That the behavior is changing. And that behavior change is very, very important. Back in the days, 5 years ago, when I wanted to make even a 2,000 rupees payment from my credit card or from some of these digital channels, the merchant was not ready to make that payment, and they were discouraging that you have to top it up with another 2% fees and others. Today, the behaviors have changed. And what has changed? Part of this is the pandemic, part of this, the infrastructural availability, and part of it is where we are empowering and educating the customer segments by making those investment in them, that this will help you. The more and more these transactions getting into the digital systems, it helps all of us as investor, as the FSPs, to understand the customer behavior. We do not understand the customer by talking to them. We as a bank, and I'm not saying it on behalf of a bank, but we understand based on their financial transactions, what visibility we have it. So I think the more and more we are able to empower, and this is what, when we, Micha, to your question, when we look at the FSPs or when we invest or from other pillars, our approach is to look at how more and more footprints you can create by empowering those customers. I hope I have been able to
Yeah.
touch
Are
upon.
there a set of impact metrics you have at Axion saying that these are the things you should be collecting? Do you tell your FSPs that these are the 4, 5 things you should be collecting and this is how we will measure? the impact you've created. Anything on that?
No, no, absolutely. So we have the metrics, and I think usually there are those standard set of metrics where you keep on looking at it. What has been your outreach, or what has been your product enablement, or how many of your customers have been able to touch upon on this products. So these have been the standard industry practices. But over the years, and particularly in last 5 years, we have been even more nuanced. And I think there is largely we like to go with the objectivity in those, so that you can measure them. But there is some subjectivity also has started to come and play the role, and a lot of it I was already seeing in the framework which you have outlined there, that how some of this is really helping the customer in making that decision. So it's not about just touching or subscribing to the product, how I have started to think about it, whether I have enough money to save or not save. And it's okay to have a little bit of again, not everything can be subjective, because from a framework perspective you need to have certain numbers to be communicated, so that to the FSPs and others, or the impact investor, you can show this is my business case. But even at Axion, we are looking at it how this delta is moving from X to Y. So we have that. And from an impact perspective, I think given how the industry dynamics are changing, how the customers are changing the behavior, we are also evolving. So right now at Axion, we are doing a strategy refresh, where given the landscape changing, we are relooking at it, that how these impact indicators at the portfolio companies, at the customer levels, need to be relooked at, so that we have the better understanding of resilience, we have the better understanding of their financial well-being, and how the delta is moving.
Thanks, Abhishek. That sounds great. So I think we're at 11 o'clock. Are there any questions from the audience? Yeah, please. Would you have a mic, or would you like to come up front and ask your question, and also introduce yourself, please?
I think I'm audible. I don't
Yes,
need a
you
mic.
are.
So my name is Taral. I'm a faculty with B School in Ahmedabad. MICA is the name of the B School. And I work in the area of sustainability, CSR, and impact measurement. And so this discussion has been beautiful, and I don't know a lot of us, if we are aware that there is a new model that just came up through the discussion right now, and I'm referring to a model given by Deacon in 1988, which is very similar to what Susan was talking about in terms of an input and an output model. So here is what this model is, and maybe I'd request you all to reflect upon it, although it's come through your discussion only, that financial well-being is a product of financial behavior. And that's a term that Abhishek just mentioned, which is financial behavior, a moment ago. And again, he mentioned a term which is demand side a moment ago, that financial behavior is dependent upon demand side factors and supply side. And supply side is the FSPs and the Axis banks of the world, where so like when Abhishek said that a show of hands in terms of who feels that his or her financial, retirement is secure, and you just saw 4 or 5 hands go up, I'm sure nobody sitting over here would go on to say that, oh, I wanted to invest in a mutual fund, but the product wasn't available. So the supply side was sorted. What isn't sorted is the demand side, which governs the financial behavior. And that's where I think, the industry in terms of an ecosystem where Misha was saying that, are we expecting too much from the industry, wherein a little bit in terms of financial literacy, a little bit in terms of I think, Seema, you used the term empowered customer. So empowering a customer is going through that journey of, financial literacy. If that is being done by the industry, then I think the demand side, so the two stories that you spoke about, that woman in Northeast wanted a change, and hence, getting the product to that customer, and she latching on to the customer was very easy. So I think maybe the industry and the academia, at the school level, maybe things need to be done where there are basic courses on financial literacy, and maybe there is one aspect which is totally missing, which is ethics in finance. There is so little that people talk about in terms of ethical finance, that children in school and, even in B schools where MBAs are produced like hell, people don't talk about it. And once this comes in, I think the demand side factor kicks in, which propels a change in, financial behavior. Right. So maybe your thoughts on that.
No, thank you very much for that great insight. I think could not have agreed more. And you touched upon two very important points, and I think which we should maybe have covered here is one is the basic financial education at the school level, and I think, and second part you touched upon the ethical financing, and I will go actually first to the basic financial education, basic financial understanding to our kids, our children. An unfortunate reality is, while we go through with these great programs on the financial management of that, but nobody teaches us how to really save the money and why saving is important. And even at my home, I'm seeing there is a piggy bank there. That piggy bank is lying, but that piggy bank doesn't mean when we come to the sophistic world as we go and graduate, how we will really use these concepts towards. So I think it is utterly important, and we should start working towards it. And there is very little. In fact, we at industry level, we at Axion keep on lobbying about it, that this financial planning, financial education, I do not like to use the word financial education now anymore, but I think I fully agree with you that this needs to be taken towards the at the basic level of teaching our kids in the school while they are at primary levels, that this is how this needs to be done. Second, then coming to your point in terms of the ethical financing, I think if we have taken to that level, then we can always graduate to the next level, which is in terms of that why this whole ethical financing and why this becomes important. Could not have agreed more. And in terms of, I think, looking at it from the angle of is it the, and which I touched upon a little bit from a push product and others, I still feel that there is a lot of responsibility which is lies within the institution. And my panelist commented here, he brought a beautiful analogy of the financial well-being from an health sector. While today we are not having enough trust on the doctors, how can we go back? And there is a lot of trust currently in the financial services industry, particularly in the financial inclusion segment. I will not call that trust out there at our level, which is why we are not able to subscribe to the products. The reason we don't have enough retirement planning, one, we are not being told about it. Second, I myself had the experience of not being able to subscribe to a pension product for close to 2 years. IRDA has a fantastic product, which is pension schemes under the NPS, but nobody talks about it. None of the banks, none of the financial institutions are talking about it. And a lot of landscape has changed in last 2, 3, 4, 5 years, only because this has been enough rewarding and making money for the FSP and others. So some of that need to change. Some of this needs to be more trust being. And just going back to the point, I think given that in the financial inclusion segment, our microfinance customers continue to trust us a lot because there is a physical touch and connect, we need to leverage that. And by leveraging that, I think we can empower them more and more and just can redeem it for everybody's benefit. I don't know if anybody else wants to comment on it.
I'm just adding on to what Abhishek was alluding to. So if you look at the LIG customer today, and when we go and meet them, and we have our group meetings, we meet these women borrowers. The first thing that the industry believes in, that this is a segment where the intent to pay is extremely high. This is the last segment that we would have a measurement to say whether they would intend to pay or not. We have seen even during COVID days, with floods around, when we have approached them, they have come out and given the money. So from a ethics standpoint, the trust factor that this segment has and the credibility that the FSPs have derived over a period of time is it's immense, and that is there to see as the market grows and market is expanding. There is clearly a need for credit and the other savings and pension and remittance products. And more, the financial literacy program is broadened to address these services. We believe that this is only going to help the segment in terms of awareness. So when you go to a little bit evolved segment, the issue is not about awareness, issues about choice. You're spoiled for choice. Your ability to take a decision which one to go for is somewhere overplayed with your ability to comprehend and analyze, right? So, but if you go down to the low income household segments, with the limited information coming is the trust and the relationship which overshadows everything else. And they believe you as a financial advisor, they believe you as a as somebody who's walking the path with you, and they see you in and out every month, right? And that's a trust which drives this business. So financial literacy program has evolved over a period of time, and what you say is there to see and believe that it's happening in this industry. That's a little from my end.
I'd like to just add one point here that in 2017, the Financial Reforms Committee, so the first recommendation which went to the Prime Minister by the committee, which was Arthik Shiksha Abhiyan, which is let's start providing Finance 101 to starting from middle school onwards. So I urge everyone here to actually, we've written to Niti Aayog also about it. It's very important to catch them young and teach them on the foundations of finance so that we can have financially empowered individuals. Yeah, thank you.
Great. Any other final questions? Yeah, please.
I am Gurpreet Singh, District Development Manager, NABARD, Patiala. So I would like to say that as Sir asked about how many people are comfortable about future. So as it is said that middle class is only one sickness away from poverty. So that fear is always there. And regarding financial well-being, I think the metrics that you have prepared, as you yourself mentioned, that you will be needing time studies also after time. So it maybe it is a mammoth task. So a mammoth task. What we can do is we can have a concerted, unified efforts to study correlation between form of finance. For instance, we can say that farmer suicide. So if the whether it is due to formal finance or informal finance, similarly socioeconomic indicators. So we can just use the data of NSSO and we can have unified correlations. And even RBI and NABARD is working. They have some efforts towards public infrastructure investment and credit outstanding in a particular district, and they are trying to study correlations with the socioeconomic indicators. Having said that, my question is that at a macro level, that when we see that credit is increasing, but at the same time we have a data that uh, the CMIE reports that unemployment is also increasing. So for Haryana, it is 36%. So as we are formalizing our economy, and if we have unemployment of 36%, so the credit increase will apparently go to non-productive purposes or consumptive purposes only. So how do we see that? How do we see financial well-being while our financial inclusion is increasing and unemployment is also increasing? Thank.
Super question. Would like to take that? Think.
So no, absolutely, you are right on the point that when you see the credit going up and unemployment going south broadly, it really is on a different dimension. So let me take example of Kenya actually. So Kenya has been a poster child for financial inclusion for everyone. We see that they're already at 92% financial inclusion level. But in the last survey, which was done in 2022 by FSD Kenya, the financial health actually fell from 2017 to 2022 between by almost like 12 basis point. Okay, from 56, some 54% to 41%. And the prime reason for that was credit. That we saw Kenyan market has a big shift towards with M-Shwari and those kind of on-the-fly products, and people were consuming a lot of credit, as you said rightly, for unproductive purposes. The question then now the policymakers are posing in front of them is, is it great to make all the products so frictionless, that it suddenly spikes up how you start interacting with those products? Okay, and that is what we are all trying to question over here, that if we beyond the access and usage metrics, if we bring in the financial health or well-being metrics into it, is there are ways to better create better choices for customers, help them make better decisions in terms of how they need to interact with the services, and be it better off for that matter. I'll give a case in point and pick from Abhishek's earlier point on UPI transaction going up and how it's easy to just do a transaction. And this is again speaking to a fellow banker just 4 days back, and they were saying that they have seen because of UPI the consumption pattern has suddenly increased, but the disposable income hasn't increased. Okay, so that means people are consuming more because we have made system so frictionless. Okay, that if the income is not increasing the same rate, then you are basically getting in a situation where you will again be stressed out on the financial health side in few months or years to come. Okay, so the question we need to all be asking ourselves is that you are right with all of the indicators, but while digital is a good tool, does it need to be all frictionless in the same way? Okay, and can it be done a little different and better?
And maybe just to add there, I think, just to supplement but what has been said by Jaspreet, I think we also have to be a little bit aware of the reality that last 2 years of COVID has taken out a lot of work which has been done by all of us over last 20 years, 30 years. We at Axion have been in this space for last 62 years, and there are numerous studies. Misha already talked about it. I think we feel the pain, the work with the progress which we have seen over 20, 30 years, all has been taken out. But at the same time, on the flip side or the positive side of it is the digital side has enabled now us, it's the same consumer which we felt will not be taking any digital products is ready to do the things digitally. I keep on hearing from my microfinance partners that in the past that the disbursements cannot happen digitally, collections cannot happen digitally. Now the same set of practitioners are telling us they are seeing digital collections in the range of 10% to 50% in a period of 2 years. And these are dramatic changes. So I could not have agreed more with Jaspreet that are there going to be some inherent challenges by making some of these frictionless, or is it going to shift the dimension because of the credit being higher than the economy or the income levels? Part of it, that income data has not been really realistically available. If I look at my microfinance partners, there was a tick, ticking the box approach to find what is your income really. I do not know how many practitioners were literally really looking at, and Misha probably would vouch for it from the research approach side, that really looking at the household income level. So we do not know today that is it the 4 members, 5 members, 1 member working at the household level. What is happening now today with the digital footprints being created, we are starting to learn, okay, we will have the income side of data. We are starting to see the expense side of data. So I think we are in that evolution phase. My point is that we are in that evolution phase where there might be some course correction also because of this difference into the income equality and the credit demand side of it. But I think we got to see with that is still being played out.
Yeah, yeah. No, actually, one quick point, very eager to highlight to the audience as well as the panelists here. We, in the framework we propose, we're treating credit very differently. We're not including credit into the inputs part because credit, we're treating it as a contextual factor. And we're asking how different is your financial well-being if you have a loan outstanding versus how different is your well-being if you do not have a loan outstanding. So we are quite keen to look at credit separately and treat it separately. So I'll wrap it up here. Thank you so much for your engagement, and thank you so much to all the panelists for your insights. I think we have a lot more questions, but we couldn't get through it. Really look forward to working with each and every one of you to operationalize the framework, not just us, but to build a consensus on what a best framework would look like. I think what I heard is a best framework would have both subjective and objective measures, and we need to make it cost effective. We need to build a business case for FSPs in bringing that up, and would really love to work with all of you on that. Thank you so much.
Misha, if you can allow me just to make one statement. I think it was the last slide, on the last slide, what Susan has wrote it out. India is a natural lab, and I think we all will agree with that how we are evolving. And I think let's look at it what the framework has been developed with the financial inclusion angle, and really given how the jam trinity, how the financial inclusion is happening, how we can take the approach of financial well-being together out there. Thank you very much for that.
Thank you very much, the esteemed panel. This was such an insightful conversation that we've gone a little ahead of our time. But I'd really, as a token of appreciation from IFI Summit, once the panelists are stepping down, kindly take the pictures and the souvenirs that we are offering. We will now break for 5 minutes, and we can reconvene in this hall itself for the next session on affordable housing and finance. But I'd really like to thank all of you to be here. Thank you.